FM 1033. The Answer.
Portions of the following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings.
The following program
and
is
nurture
pre-recorded.
your investments.
Portions of the following program.
This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments in your retirement. Here on the Max Out Savings Show, our show is all about saving money, building up wealth, and understanding a very complex world today and how to protect your money. Our motto and our philosophy is to save aggressively and invest conservatively. Save aggressively and invest conservatively. That's the key, my friends, to building up wealth over the long term. That's why we always try to talk about it. But coming in on year end, again, we want to hit it again. Year end, are you saving enough money for retirement? Where are you for retirement? If you're behind, now's the time to build it up. If you have a 401k, if you're between the age of 60 and 63, the government actually lets you put in additional monies for a further catch-up, so you can really start putting away that money at retirement. Once you hit age 50, that's when you have to take a real hard look at what you're doing and where you're at for retirement. And if you're not there, you got 15 build it up, which can be done. But you have to understand it. You have to take charge of your retirement. So if you're not there, if you've not saved enough money, it's the start of a new year coming up, and really now's the time to go to your HR person, talk to them, increase your savings rate at the company, and get where you need to be for retirement. Because in the world today, there's a lot of unknowns out there. You have a government that's spending money like no tomorrow, and it seems like Republicans or Democrats, nobody can control spending in Washington unless, of course, they have big lobbying operations and they get all the money they want. But what happens is this all comes out of your pocket. Right now, our debts are closing in on $38 trillion. It just keeps going up. It's going to soon hit $40 trillion. We're borrowing about $2 trillion a year. And in that environment, there could be problems. If you're recklessly running up deficits, how can you expect to fund all these entitlements, which be it food stamps, be it Medicare, Medicaid, Social Security? All of those things could be endangered with higher levels of inflation or just reckless government spending, which is where we're at right now. So take charge of your retirement, get in there, make the changes to be where you need to be for retirement. Now, we got a lot to talk about. It's really just an incredible times we live in as the financial system continues to morph. The original Bretton Woods was built up, and then we took the U.S. off the gold standard in '71, and that let gold to go up, goes up to $1,000 an ounce, and it came down. Silver went to, by 1980, went to $50 an ounce, and then actually under Bill Clinton, we actually had some deficit, some government surpluses, believe it or not, but the monetary system kind of held up as a fiat monetary system, and it chugged along for 1980 to where we are. It really started in '71, so it's over 50 years it's held together. But once the Biden administration got into power, and to be fair, both sides have been spending money like crazy, but the Biden administration came up with this new theory promulgated out of Harvard University called modern monetary theory that said, look, if you have the world's reserve currency, you really don't have any spending limitations at all. You can spend as much money as you want. And then we had emergency interest rates at 1%, and so they just said, well, we're just going to leave them there. In addition, the economy shut down under COVID in 2020, and what they did is they increased government deficits close to 8% of GDP, which is basically, you see that in wartime level, World War II, really when the country's in trouble fighting for its life or there's a depression, that's when you have 8% debt to GDP. But they didn't have big inflation right away. And so they figured, hey, we'll just keep spending that money. So they ratcheted it down to 6% and just started recklessly spending money. It's continued up through Trump now. And here we are, $38 trillion in debt, and no sign of it slowing down. And so the question is, where do we go? In addition, they kept interest rates artificially low. So you built up all these artificial excesses where many people had too much debt because they figured debt would go on forever. And now the world sees what's happening. They're like, wow, these guys are spending money. They're following modern monetary theory. So we all know that the minute the economy slows down, they're going to be printing at probably 10%, 8 to 10% of GDP. There's no way our dollars are going to be worth anything. And then just to make sure it was going to fail, the Biden administration during the Russia-Ukraine war probably made one of the most gravest foreign policy mistakes in U.S. history when they froze the Russians' foreign exchange reserves. And as soon as they did that, that changed the world. Everyone in the world, if you're a country, you've got to manage, you've got to protect your citizens, you've got to help them out, feed them, create a structure of government and rule of law, but you also have to defend them in wartime. But you build up foreign exchange reserves, but if the U.S. gets mad at you, they could confiscate your foreign exchange reserves. So the problem is everyone in the world had to go find an alternative to the U.S. dollar. And then they looked at Russia, which seemed to function pretty well with gold, and then they started realizing they have to get away from the dollar. So here we are today. Since then, gold has gone to $4,500 an ounce. It's up over 65% this year to date, the biggest run in 50 years. And silver is up close to $79 right now. Another massive breaking out of a triple top that went back 50, 60 years or more, as well as countries scrambled to get hard assets to replace treasuries. And so in this type of world, this is why you're seeing people are like, Ted, why is gold going up? Why is silver going up like this? People want a couple things. They want an alternative to the dollar. And this is important to understand. They want an alternative. So if the U.S. gets upset with them, they don't lose all their foreign exchange reserves. In addition, the gold and particularly silver is going up because in the past, every time there's a crisis, the United States steps up and bails everybody out with printing more dollars, more treasuries, and if any countries or even sometimes companies have problems, they give them money or treasuries to sit there and stabilize the situation. If banks have a collateral problem, they give them more cash. But the problem they just print more money. But the problem with gold and silver, you can't print more money. And so so what we're seeing is a collateral crisis in the world. And we have to see how this plays out. It could be a very serious situation because there's a lot more paper money out there than there is gold and silver, and you can't print any more gold and silver, and so the problem is how do you trust the counterparties of different types of trades out there? And as an example, silver's up 170%, over 170% year to date. Huge move in silver. There's about 830 to 850 million ounces produced per year of silver. Now, for the physical silver that's out there, there's about 300. It's between 300 and 400 times derivatives contracts, which are. And this is important to understand because this could lead to a problem, and not just affecting silver. The numbers, one of the numbers I came up with 356, but the numbers seem to be between 300 and 400. Some people say more than that, but 356 ounces of derivative contracts for every ounce of physical silver out there. So we have now. What's a derivative? Well, a derivative just might be an option. It might be an ETF. So most of those are backed by. It could be the futures market, the COMEX, the futures. It could be swaps. It could be all over-the-counter derivatives of some type, where it could be we'll agree to deliver 10,000 ounces next year at if the price is $50, they say they'll give you $55 in the future, and you say, oh, this is a good deal. And in addition, there's people that have lent out the silver. They said, look, we'll give you 7% a year, so if you give us back the silver. Well, here's the problem. What if these people can't deliver the silver they require? What if they can't buy back the silver they've all shorted? J.P. Morgan, some of the big companies, particularly J.P. Morgan has been massively short in silver for decades, making a fortune, manipulating the silver market. UBS, there's some other ones out there that have been involved in this. But if there's 350 ounces of paper contracts out there, of all types of contracts, but there's only 1 ounce of silver, there becomes a scramble to, hey, I want to make sure that does my counterparty have the actual product or not? Do they have the collateral? Well, the problem is the Fed can't print more silver. Now, in theory, there's probably some silver at Fort Knox that they can lend out and try to stabilize the market. But this goes back to the world is shifting, and they're going to want to, as it becomes more unstable, they're going to want to see more collateral, and they want to make sure their contracts are good for silver. Well, what if this spreads elsewhere? What if it spreads to the oil market? What if it spreads to other contracts? Do the people have the ability to deliver other contracts, other commodities that they've promised? Because remember, commodities haven't really gone anywhere for decades, particularly gold and silver and other commodities. Aluminum's going up. Platinum has jumped up like I want to say it's like it was up 10% in one day here recently. Actually, silver was up about 8%. I think platinum's probably gone up over 15% in the last week. There's a scramble for physical. There's a scramble for collateral here, and this is very, very complex stuff. But if we're moving a world from a world where the collateral are treasuries over to something where we want to make sure that it can't be printed more, that it's not to depreciate and be depreciated, but into a collateral that is concrete. Say your house or something. When you get a loan, you go get a mortgage on the home. When you put your home up as collateral on for the loan. Well, what if I go get 5 loans, for let's say it's $500,000, for the house I get so I go out and get five different loans on my house, pledging the collateral at each house in a different way, a swap, a derivative over here. Then I go on somewhere else and get another mortgage. So so the problem comes in is if I quit paying and they want the house as collateral, all of a sudden I've got 5 people wanting the same house. So then the demand I got to find other houses to get in there, and that's the problem in the market. But the question is, does this destabilize other parts of the financial system? And are we witnessing, which I think we are, a restructuring of the financial system, and it's being signaled by gold and silver? It's very, very unusual that gold and silver are running like this and the stock market's going up like it is. That is almost pointing to some type of scramble for assets away from cash out there, and I think this is going to play out over time. And I tell you what, we're coming up here on a pretty hard break, so I'll be right back right here on the Max Out Savings. And we're going to talk some more about this and what to expect for 26, and what about other areas, and what about the markets, and what's going to happen in 2026. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
FM 1033. The Answer.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show, talking savings investments in your retirement here. And I've mentioned one of our sponsors, Rangoni Alto Gin, a fine botanical gin from the northern Italian Alps. It's put together with completely organic, natural botanicals, mountain glacier water, and then they distill it into just an incredible gin. They've been doing this for hundreds of years at this distillery, and some of the recipes go back 1,000 years or more. And so they just come up with just a phenomenal product. It's the Rangoni Alto Gin. It's a botanical gin. You can pick it up at Specs or Total Wine. Look for the kingfisher bird on the label. Now, if you got any questions or comments, you can give us a call at 713-339-1070. Now, what we're talking about the markets here. We're talking about for 2026. The big winners were really precious metals, gold and silver. I mean, this is something we talked about in for 2026. Looking back at 2025, we sent out our free Max Out Savings Report. This goes out once a month. It's completely free. You're not going to get a call from us or anything. It's just simply a report I send out, and we've been doing it for a long time. The first one actually talked about a bull market, a 20-year bull market in gold, and I was wrong. It was at 250. I said it was a 20-year. It's actually been about 23-year bull market in gold, and so gold's going up 20 times since our first Max Out. And we said, and we talked about, that's when Ben Bernanke said he had a helicopter, and if they need be, they could flood the system with money. And that's when I realized what was going to happen. And so we've written about this a long time. We've talked about it. But in our report last year, a couple things we said for 2025, just to kind of review. We talked about Treasury bills and notes out to 2 years yielding 4.3%. We said high quality corporates. You want to diversify because we think in the next crisis, high quality corporates are going to perform better. I think we've been proven right on that. And we said we believe some high quality corporates are going to have a lower default risk than Treasury bonds, but you got to be very careful in that. I mean, we're pretty picky on our bonds at Max Out Savings Advisors. We don't want to be in financial corporates and that type of stuff, but and we really talk about most governments have a history of defaulting in their bonds. Just 6 nations have never defaulted: New Zealand, Australia, Thailand, Denmark, Canada, and the U.S. The UK actually defaulted on some intercountry war bonds. That's of all the countries out there, and we write about that. This is from last year. We said we thought the energy sector would be a good place. It's been beaten down by tax law, selling should outperform in 2025. I think it did. I'd like to see it a little bit better. By the way, we said that we do not expect Trump's drill baby drill boom to ignite a drilling boom. This will trigger overproduction, causing a drop in prices. We said companies companies are going to cut capex, and that's you're going to be a big thing. We were correct on that number. We said the mega cap tech sector was the most overvalued sector in the market. The top 10 mega caps currently total enterprise value is 64% of GDP. The bubble during the tech bubble was only 28%. That's kind of they did better than we expected. But if I look at the let me kick over here to the Bloomberg here. Bear with me just a second. If I look at the performance year to date on the tech sector, Apple's up 9%, Google's up 66%, which was good. NVIDIA was up 41%, Tesla was up 17%, Microsoft was up 16%. A lot of them just basically kept in line with the market. Of the big ones across the board. Meta was actually Meta was 13%. So they didn't really do that great. The big winners were really precious metals. What else? We like commodities. Given the global inflation environment, we like the sector. We talked about the positives of reindustrialization. This will be positive for aluminum, copper, silver, other metals. With the higher debt, rising debt levels around the world, with wars with Russia, China, Iran, gold and silver should continue to rise. Silver will outperform gold. For 2025, we expect the metal stocks to actually outperform the commodities themselves. So I think it's a pretty good record of what we did this year. We're really pleased with how the year went. But I just want to kind of go over that, to tell you what we did in the past. And as I said, look, this is a free report. Just go to maxoutsavings.com. We send it out once a month. If you're interested, we're going to be writing our new one kind of for the outlook. Some of the things I'm looking at, I think 26 is going to be a more volatile year. I think the economy should do well because we're really ramping up production of defense, everything from bullets to missiles to tanks to aircraft, and that's really ramping up. In addition, Trump's tariffs and his negotiating prowess has gotten a lot of companies to move. We think about $500 billion worth of factories back to the U.S. over the next couple of years. That's going to be bullish for the economy. And then AI, you're looking at probably hundreds of billions of dollars worth of spending for AI data centers. So I think the economy is going to do reasonably well. We came in, the GDP for the third quarter came in at, what was the number, 3.4 or something like that, which was above expectation, 3.4, 3.6, which was 3.8. The expectations was 3, but the fourth quarter is not going to be good because of the government shutdown, which is going to put more production into the first quarter. Look, President Trump, they have to win. the congressional election. They can't lose the Congress next year because understand the United States has morphed more toward an African type of South American type of country where you have these polar sides, and if one side gets in, they want to jail the other side. And I think Trump's been remarkably patient. Honestly, I can't believe they haven't put anyone in jail yet for all the talk. But the Democrats, they're going to want to impeach Trump. They're going to want to investigate Trump. They're going to investigate all the cabinet members, anyone that's Trump. They want them all to go to jail and basically be hung. I mean, I'm not even sure that's an exaggeration. And so that makes these elections a lot. What used to be the midterm elections weren't any much more critical, and so Trump is going to do everything he can to sit there and get the economy going for next year. Now the question is going to be, how does the market do? And I think it's going to be much more volatile. The question is, does the market break out in here or not? It's up about right now about 16% or so. Looking at the charts, it really hasn't gone anywhere since October, and a lot of the tech stocks really peaked in July, September timeframe, and they've been selling off. There's something called distribution in the stock markets, and what that simply means is big players are selling stock, and so good news comes out, it goes up real quickly, and then it just starts going down, drifting down as selling comes into the market, and particularly the big tech stocks. Particularly Oracle, I believe there's been massive, very large holders of that stocks, of a lot of them selling across the board, and you wonder what is the problem? What do people seem to see? And strangely enough, right when gold started moving up is really when you started seeing gold really started moving up in September, and if you look at some of the it was really triggered in September. It's like somebody flipped a switch, which no one's really given me. But if you look at things like Microsoft, they really weren't. August, September, they peaked. It went down. If you look at some of the others, if you look at Meta was kind of peaking August, September, and it's gone down. If you look at a lot of these Oracle peaked in September, so right when gold started taking off, all of a sudden the big tech stocks started selling off. And no one's really made any connection to that at all, but I find it very interesting. And so I think the economy is going to do very well next year. I'm not sure particularly the big tech stocks will. They haven't gone anywhere from they could run, but I think it's going to be a very volatile year in 2026, more so than we've seen in 2025. And so this is something we want to kind of continue to watch, to see what happens. And I think you have to be cognizant and really manage risk. You want to have higher levels of cash. At Max Out Savings Advisors, we tend to run higher levels of cash. I mean, we've been able to turn in very, very, very good performance this year. With higher levels of cash, most advisors, they've got 1.5%, 2% cash, which if things go down, they're going to be in trouble very quickly. And if you look at that collapse in April, that was about a 10% drop, 10-15% drop in 3 days for many stocks, and so I think it's going to take a much broader move in the market, much more broader. You want to have your assets, your retirement savings in a larger number of assets than the simple concentration of the 60% S&P 500. Maybe it's 50% S&P 500 and a few small caps and mid caps and maybe 45%, and then so 15% small cap, mid cap, in some foreign, and then 40% in long treasury bonds. And that didn't work in 23. That's 23. Wait, 23. Or was it 22? When that combination was down over 18%. And so if you know how to manage through these things, you can avoid that. But I do think it's going to become more and more important. We live in a very unstable world. We're trying to get get Maduro out of Venezuela. That should have been an easy thing to do. We've offered him money and stuff. So clearly the Russians and the Chinese are convincing him to stay, to try to drag us into some type of problem down there. And so these are some issues that we really have to deal with and watch very closely. And so that is causing, is China going to go into Taiwan? A lot of people for the last 5 years have been saying they're 26, 27, China was going to do something with Taiwan. They have a window. And again, we're not sure what's going on there. We're hearing Israel wants to do something with Iran again. We don't have the Russia-Ukraine war solved at all. And so these are a lot of complex issues. And we have a new Federal Reserve president coming in the first quarter of 26. Well, typically, people forget Alan Greenspan came in, I want to say in the summer of 87. Well, the crash of 87 happened within 4 months of him getting into office. Typically, the markets test a Fed governor. So what's going to happen is Trump's going to get his guy in there. Yeah, I'm cutting rates all over the place. He's going to cut rates, and the long bond is going to go. The rates are going to go up. The markets are going to do something to force to test to see how the Fed chairman reacts. And so this is all coming in 26. So again, I think you want to be additionally cautious in that environment. And so I still like the shorter term bonds, so the rates are getting lower now. And I still like the idea of owning treasuries plus owning very high quality corporates. This is something we talked about in 25, because if there's a problem in the treasury market, bonds like the Exxon or a Chevron or a railroad, assuming they don't take somebody over, those type of bonds we know are going to be there. We know if they've got if they're highly rated, if they're in an industry that's reasonably stable, or there's a lot of demand in there. Something like an Oracle bond, they're building data centers all over the place. You want to be in that? No, that's why the credit default swaps are so high on that. So this is, it's something. Financials, you don't want to be in the financials. Is there going to be a financial problem out there? Does commercial real estate get worse? That's what we're not sure of. Do the long rates go up, which could hurt some of the banks? Is there collateral issues in the precious metals market that can start cascading over to the bank side, or other things? These are some of the things we want to watch, and so you don't really want to be in those type of bonds, because when things go bad, they destabilize in the credit markets in the bonds. So you want to own. You want to own things. Remember, what did we start at the beginning? So we talked about the importance of collateral. I know they got the railroad there. It's making money back and forth. There's only so many railroads, and so even no matter what happens, the railroad is going to be around. Years ago, one of the crises, we bought Hess bonds. Got a heck of a deal on them. They actually had to battle to get the bonds because evidently someone else was trying to buy them too. But we looked at them and go, well, look, even if the oil was like $20 a barrel, it's going down. We looked at, they had the biggest discovery in 25 years in Guyana with Exxon. You figure, well, worst comes to worst, Exxon's going to stump in and take over the whole thing and make our bonds money good. You have to have that type of mentality. There's a lot of money to be made in bonds, but can be a lot lost. Private equity, this is another area. There's a lot of problems. You got a lot of guys running around making deals all over the place. I think we talked about there's more private equity shops out there than there are McDonald's. And you got all these people making bad loans, and that's all going to come back. See, what you want to do is you want to be in the high quality collateral, because the next crisis, it's going to be about collateral. And you want to think that way through. That's going to be one of the things, and that's what we're seeing out there. We're going to talk about that after this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
In the 1970s, the big song was the Bee Gees' Staying Alive.
Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
FM 1033, The Answer.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
I'm Ted Gioka, and I approve this message.
Inflation, instability in the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues. And that's where Ted Gioka can come in, and he can help. Go to maxoutsavings.com and schedule some time with Ted. That's maxoutsavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 1033. The Answer.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. I want to touch base on the silver and the gold situation as well. A couple thoughts on that. I don't think it's really been kind of out of the mainstream, particularly the business and media in general. They're so busy talking about AI and NVIDIA all day long that they really haven't had a chance to get to anything else. But these stocks have vastly outperformed the tech sector overall. And let's see, just looking at some of them year to date, I'm looking at some of the big ones on my screen. They're all up over 150% year to date, pretty much right across the screen. Many of them are up more than that, and so it's been a very good year. Silver is trading at $79 in Asia right now, as we're talking, and we've had a big move up. We've been in these things for a while. We have very substantial profits. I'm not sure you want to just pile in right now, and I'd be careful. I mean, I think even if you look at it, even if you sit down and look at, typically they have these sell-offs, but it's broken out of a triple top, which is very unusual. I mean, that tends to cause a big move, and it's since then it's run up almost $30 off of that top. But it always, if you look back to 1980, and it came back, it went back to about trading about $7-8 an ounce into the 2000s, and then it hit it again, and then it traded really. It kind of averaged about $25. So the likely thing is, even if this sells off, you're probably looking at $40 plus average on silver, and it could be more, and which should be very popular, very profitable for the miners across the board. And many of these, if you look at the gold and the silver companies, aren't at just sky high multiples in here, and so I think this is something. But I want to touch base on a few things on the silver, which is it's always interested me. But if you look at it, a couple things to understand is the COMEX is raising margin rates 10% more, I think up to 13.5 or something like that, starting Monday morning. They're trying to slow this down, and I'm kind of surprised that silver's up at 79 with that news. But what that kind of tells me, and they'll probably try to knock it down Monday morning with big sell orders, but they're not raising it up a whole lot, which means they're trying to kind of stabilize the situation and slow it down some. But the important thing to understand about the gold and the silver is, particularly silver is the easiest one to understand, is 1980s, that run to $50. Keep in mind, that was $50 45 years ago. So guess what $50 is worth now? You're probably looking at 170 or something, but that was run by the Hunt family. They cornered the silver market and they ran it up. They actually had it completely cornered, and then the COMEX basically said all you could do is sell, no one could buy anymore, and the price collapsed. But there was a lot of speculation. There were speculators buying on COMEX, and there was some people, but it was all Americans. Okay, what makes this move fundamentally different is that this is being led by central banks, with gold, and to a lesser extent silver. It's being in India, in Saudi Arabia, in Russia, in China, in Turkey, in Kazakhstan, in Poland. This is not speculators in America. In the 1980s, it was all Americans and some Europeans, but mostly Americans doing all this stuff. Asians weren't even in the market for all practical purposes, and they were just backwaters almost at the time. And so this is being. The Asians have massive savings pools. They're looking at the world. They're looking at our deficit. They're going 38 trillion. I'm not even sure what that is, but it seems like it goes up another 2 trillion every year. What can I buy? And they're buying gold, and they're buying silver. There's lines at the places. China's trying to slow down. They put a VAT tax on gold jewelry here recently. They're trying to slow it down there. So this is being driven by cash buyers, not speculators on the COMEX like it's been. There's a lot of people, as we talked about on the show, there's about $350 of derivatives, of futures contracts, swaps, ETFs of some type or another, or also what's the other one? It's the over-the-counter derivatives as well. So these guys are all in trouble because a lot of them claim they were going to deliver gold they don't have, or they shorted gold and they can't. They're having trouble buying it back. That is pushing things up. Now, and so it's a different market, and so just raising the margins on the COMEX isn't going to do it, because that's not going to slow down the Asians at all. They're paying cash. They want the gold in their vault, and that's it. And the other thing that's happening, there's big demand for gold and silver, particularly silver in AI facilities, solar, electric cars, and Samsung has come up with a new silver battery that can go 1,000 miles and recharge in like 10 or 15 minutes. And it's going to require about a kilogram, which is about 32 ounces of silver in each car. Samsung has bought the production of 2 years of production from a mine in Mexico. So so this is additional big demand for silver. And if you look at silver, the silver, as we said, typically the mines produce about 850 million ounces a year. Well, the demand has been running about 1.5 million to 1.1 million billion ounces per year, which has led to about we've had 5 years of deficits. This year the deficit is going to be about 184 million ounces. So So what's happened is there's big demand for silver out there. And so the question is, where does this go from here? And I think we want to watch, but is it going to create some type of problem? As we talked about on the show back in Thanksgiving, the weekend after Thanksgiving, the COMEX, which is the American Commodity, Futures Exchange, they have contracts in gold, oil, silver, everything. Well, they got redundant systems all over the place. It functions, they can function 24 hours a day. They have backup everywhere. Silver broke out the day after Thanksgiving on Friday, broke through the $50 triple top that went back over 50 years, broke through it, and the commodity exchange failed because there was an air conditioning issue for 5 or 6 hours. Now, clearly, they were scrambling to try to stabilize the market and get the thing calmed down, which is very rare. And there's also rumors of meetings this week with the banks, some secret meetings with the Treasury to try to stabilize it. But the thing that we have to watch closely, is this going to cause financial issues elsewhere? Is it going to cause financial issues in the market? And if they can't deliver the silver on the exchanges, it badly hurts the U.S. financial system because there's all these derivatives out there for everything from gold to aluminum to oil. Well, if there's a problem with the derivatives in silver, what about the other ones? And that's going to cause a run on collateral. And so, again, I think 26, one of the big stories for 20, and I'm trying to sit there and keep this as simple as possible. This collateral stuff is incredibly complicated, but I want you to understand is you don't need to understand all the ins out, but you want to understand that you want to own collateral. It's like we were talking about the bonds. Well, if they have a railroad, we know where the railroad is. The railroad's not going anywhere. The bond might go down somewhere, but we're not going to get wiped out. And that's you want to. So for 26, it's going to be who has collateral, who has assets, and who has just a bunch of paper. And that's going to be one of the things that's going to be watched. This is people clearly when they're buying gold. This is central banks buying gold. This is people, particularly Asians, buying gold. They want collateral. They want to know that's in the vault. They want to know where it is, and nobody can touch it. If the banks fail, if anything fails, they just walk over to the vault and get their gold out. It's there. Now maybe it goes up or down some, but that's what we're looking at. So that's kind of what we're looking at here to try to understand. So for 2026, you want to continue to look at who has collateral, who is producing things, who is making things, who has the factories that are real, and what companies are just making. So that's going to be one of the big stories, so the key to watch is what does the COMEX do with the margin requirements? But the problem is, what if it doesn't stop it? And that's what they're worried about. They're trying to say, do these issues spread elsewhere? And this is something we want to watch closely. Oil's another one that everybody says is going to go down, but if you look at oil prices at 56, 57, if you look at long-term inflation, these are very, very, very low prices. And I think President Trump is under some real pressure to get oil prices up a little bit, because if oil gets in the $50, there's going to be a lot of layoffs around the country, and that's going to be a problem. And if you look at it on an inflation-adjusted basis, this is one thing we did with the gold and silver we've been talking about for years. If you look at it on an inflation-adjusted basis, these guys keep printing money. There's more and more money. There's more and more debt. So if you really sit down and look at it, well, that barrel of oil is worth something. That ounce of gold is worth something. They can't print any more of it. There was kind of the big thing with the crypto. Here's the thing for 2026. We're going to find out, are these rumors about problems with potential quantum computing cracking the blockchain, is that going to be a problem for those guys? And because crypto should be performing better than it is. I mean, if you sit down and analyze it, there's all types of good news coming out on crypto, but it just hasn't acted well. So this is something to watch. Markets have been real quiet in here. Expect things to change very quickly at the start of the new year. Oftentimes markets move, particularly for the first week, counter-directionally, And so this is something we want to watch. But it is interesting that to me that we've been watching is we actually still have our hedge on, which we'd like to close out, thinking of closing out. But I'd like to see some type of stabilization where this market really either breaks. It has to break out of this trading range. It's really been since October for the S&P, and for the NASDAQ. It's the same thing. It's kind of broke. The question is it? We've had some kind of lower highs on that, and particularly on the NASDAQ, and so that's one thing. Again, I think the key is going to be risk management. I think you really want to watch risk management and understand that things are happening and they're changing very quickly, and so I think that's going to continue to be the thing. And the other thing, and I've said this if these gold and the silver stocks have gone up, and even silver, manage your risk on that side too. If things go up, they go down. We've been selling some stuff as it goes up because we've got to manage the risk and balance our portfolios. But keep that in mind. Everything doesn't go up forever, so you want to continue to manage the risk on what you're doing. And I think that's one of the important things. A couple other things. If you'd like, the Max Out Savings Advisors, we are in Houston, Texas. If you go to our website, you can get our phone number or email, and you can request an appointment with us, and I'll sit down with you and show you how we manage retirement money. Our main business is managing retirement money, trust money, long-term money. We use our value investing approach to the stock and bond markets to try to manage to grow the assets and also manage the risk. I think we're very, very good at risk management. We're very, very good at tough markets as well. And so if you need some help, just go to our website, maxoutsavings.com. It's maxoutsavings.com. We hold our assets at Charles Schwab. That's our custodian, and we simply manage it for you. So if you want an appointment, I'll sit down with you personally and see if we can help you out. Also, if you haven't signed up for our free Max Out Savings report, go to the website, maxoutsavings.com. We're going to put our 26 kind of outlook coming up here in the next week. Just go to maxoutsavings.com and sign up for that free newsletter. And remember our motto and philosophy, which is to save aggressively and invest conservatively. That, my friends, is the key to building up wealth over the long term. Save aggressively, invest conservatively. We'll see you next week right here on the Max Out Savings Show.
Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
And FM 103.3. The Answer. FM 103.3. The Answer.